It's Monday night, December 22nd, 2025, and I need you to understand something right now before the next session opens. If you think today was the event, you're wrong. Today was the warning shot. Tomorrow is the test. Because the silver market you've been watching for years, the one that pretends paper is the metal, is now being forced to answer one question it cannot dodge anymore. Can you actually get the bars? And here's why this matters. The only market that consistently tells the truth in a physical shortage is the one that is closest to the physical flow. That's Shanghai. So tonight I'm putting a number on the table that will make the mainstream analysts roll their eyes right up until it prints. Silver can hit $73 or higher in Shanghai on Tuesday. Not eventually. Not sometime next year. Tomorrow. And if that happens, Western banks don't just take a loss. They lose control of the narrative. They lose control of the mechanism. And they lose control of the price. Because when Shanghai leads, the West is forced to follow or expose the fraud. In this emergency breakdown, I'm going to show you why $73 in Shanghai tomorrow isn't fantasy, it's mathematics. I'm going to explain why arbitrage is broken and what it means when the bridge between East and West collapses. I'm going to detail the 4 specific triggers that can push Shanghai above $73 in the next few hours. And I'm going to give you the 3 scenarios for Tuesday because you need to be prepared, not just for the price shock, but for the intervention that comes after. The Asian session opens in hours. The premium is firm. And Western banks are about to discover they can no longer control the price of an asset they don't physically own. This is the story of the moment Shanghai takes control, and the West loses the narrative forever. Let's strip the emotion out and talk like adults. In a normal market, global prices stay glued together through arbitrage. If Shanghai trades higher, banks buy cheaper metal in the West, ship it east, sell at the higher price, and pocket the difference. That activity closes the spread. So if we're seeing a stubborn Shanghai premium and it's not closing, that tells you something simple. The bridge is broken. Either the metal can't move or the metal isn't there in the size required. Or delivery risk is so high that the arbitrage isn't risk-free anymore. And once arbitrage breaks, the spread stops being an opportunity. It becomes a weapon. Here's the key idea. You don't need a $10 move to print $73. You need the premium to widen a little in a thin market where buyers are urgent. If Shanghai is already printing in the low 70s, then a modest widening of that premium, call it $1 to $2, is enough to show 73 plus on the tape. Why would the premium widen tomorrow? Because panic doesn't climb stairs. It takes elevators. And Tuesday is the kind of day where one big buyer, one rumor about availability, one delay in delivery, one call us for pricing email can shove the entire market up a level. I want you to understand the transition happening right now because this is the part that destroys models. In a speculative market, price matters. Price gets high, buyers step away. In a scarcity market, price becomes secondary. Because the question is no longer, is it cheap? The question is, can I get it? That is the moment we're entering. And you can tell because the market behavior changes. Spreads behave abnormally. Premiums don't collapse. Sellers don't appear when price rises. And the paper price starts floating like a balloon with a rock tied to it. Shanghai is the rock because Shanghai is connected to physical demand that doesn't care about your chart patterns. It cares about survival, factories, contracts, production lines. And when a production line depends on silver, the buyer doesn't wait for a dip. The buyer hits the bid until the risk disappears. So tomorrow isn't about technical resistance. It's about a physical market asserting itself. Now let me show you the 4 specific triggers that can push Shanghai to $73 plus in the next few hours. Because this isn't vague speculation. This is market mechanics under stress. Trigger number 1, the premium doesn't close, it expands. This is the simplest and most brutal. If the West had free metal, the spread would be closed already. If the West had easy delivery, the spread would collapse under arbitrage pressure. So if the spread is still there and widening, it means something is clogged. And when the pipe is clogged, price increases don't bring supply. They bring fear. Fear that becomes bids. Think about it. Arbitrageurs aren't stupid. They understand basic math. If there's a $4 or $5 premium in Shanghai and it persists for days, why aren't they closing it? Because they can't get the metal in the West in the size required. Or they don't trust delivery. Or the cost of moving is rising. Any of those reasons means the same thing. The system is stuck. And when a stuck system meets urgent demand, price doesn't rise gradually, it jumps. Trigger number 2, thin liquidity makes normal buying look like a spike. Tuesday can be violent because liquidity is not uniform. The order book isn't deep everywhere. Shanghai doesn't need 1 million buyers. It needs a handful of serious ones, an industrial buyer, a refiner covering, a wholesaler securing inventory, a fund rotating into exposure because the spread screams tightness. In thin liquidity, a few orders can print a new level and force everyone else to reprice. That's how you get $72, then $72.70, then $73.15 before the public even understands what happened. This isn't manipulation. This is thin market dynamics. And thin markets are volatile. They move fast. They don't wait. And once a new level is printed, it becomes psychological. Sellers freeze because they don't want to sell too low. Buyers chase because they don't want to be left behind. The premium self-reinforces. Trigger number 3, the West tries to manage the price and fails. This is where things get ugly. If Western banks try to defend levels by selling paper into rallies, they risk triggering the exact thing they fear, a forced cascade. Because on the other side of those, paper sells are buyers who don't care. And once the market senses weakness, once it senses they can't push it down anymore, bids get more aggressive. And Shanghai sees that and says, fine, I'll take the lead. This is the bank's nightmare. They're used to controlling price by selling paper contracts. But when physical demand is strong enough, selling paper doesn't suppress price. It just exposes that paper is disconnected from physical. And once that disconnect becomes obvious, confidence collapses. If you're just joining us, we have established that Shanghai can hit $73 plus on Tuesday, not because it's a crazy prediction, but because arbitrage is broken and the premium persists. We've already covered the first 3 triggers. Now we need to understand what actually happens when the bridge between East and West collapses. Because this isn't just a trading opportunity, this is a power transfer. Let me explain the mechanics of the fracture. Western price control relies on a belief that the paper market is the market. But in a shortage, paper is only powerful if people accept it as final settlement. Shanghai leading exposes the contradiction. New York prints one number, Shanghai prints another. And the market starts asking, which one can I actually buy metal at? When that question spreads, confidence collapses. And when confidence collapses, paper markets don't adjust politely. They break. Because shorts aren't just losing money, they're losing time. A short position can survive a slow grind higher. It cannot survive a fast repricing plus a physical premium plus delivery stress. If Shanghai prints $73 plus tomorrow, it tells every short seller, you are short in the wrong place. And that's when they all do the same thing at once. Cover. But covering is buying. Buying in a thin market is acceleration. Acceleration forces more covering. That's the spiral. Now, trigger number 4, physical fear spreads faster than headlines. The mainstream always arrives late. The physical market doesn't wait for CNBC. It reacts to procurement calls, delivery times, and allocations. If Tuesday morning starts with even minor signs of stress, delays, limited quotes, elevated lease rates, tight wholesale supply, the bids get urgent. And urgency is how you print $73. Let me give you an example. Imagine you're a procurement manager at a solar company. You need 500,000 ounces of silver for your production line next quarter. You call your supplier. They say we can do 200,000 now, but the rest is on hold. You panic. You call another supplier. They say, call back Wednesday. You call a third. They say we can do it, but the price is $74. You don't even argue. You buy. Why? Because your contract with the customer is worth $50 million. And losing that contract because you do have silver costs infinitely more than paying $1 or $2 extra per ounce. That's inelastic demand. And when inelastic demand hits a thin market, price doesn't rise gradually. It jumps. This is the 4th trigger. Physical fear creating urgent bids and thin liquidity. And Tuesday is the kind of day where a handful of those calls can push Shanghai straight to $73. Now let's talk about why this is terrifying for Western banks. The banks are short. They bet the price would fall or at least stay stable. But if Shanghai leads and the West can't follow, the shorts are trapped in a vice. They're short in the wrong geography. They sold paper contracts in New York thinking they could control price. But the shorts have 3 options. Option 1, cover now and take the loss. Option 2, hold and hope the price drops. Option 3, double down and sell more paper. Option 1 is expensive. Option 2 is risky because if Shanghai prints $73 or $75, the loss gets worse. Option 3 is suicide because if you sell more paper into a tight physical market, you just add fuel to the spiral. So the banks are paralyzed. They can't cover without pushing the price higher. They can't sell without exposing the disconnect between paper and physical. They're trapped. And every hour that Shanghai holds the premium, the pressure builds. In part 3, I'm going to walk through the simplest roadmap for how $73 happens in Shanghai tomorrow, step by step, because you need to know what to look for. You need to know when the trigger is pulled. Stay with me. We're mapping the exact sequence. We've reached part 3. We've established the triggers. We've explained why broken arbitrage transfers power. Now, let's walk through the exact sequence of how $73 prints in Shanghai tomorrow. Because understanding the theory is one thing. Recognizing it as it happens is another. Here's the simplest roadmap. Step 1, the premium opens firm. Not even higher, just firm. No collapse. This is critical because if the premium collapsed overnight, it would mean arbitrage is working, metal is flowing, the bridge is intact. But if the premium opens at $3, $4, or $5, that confirms the bridge is still broken. Western supply isn't arriving in sufficient volume to close the spread. That sets the stage. Step 2, the West hesitates or stalls. Paper can't convincingly pull the price down. The market holds. The banks sell some paper contracts trying to push back to $66 or $67. But buyers absorb. Price refuses to drop. This sends a message. The shorts don't have control. Step 3, one real buyer hits size. Could be industrial, could be a wholesaler, could be someone securing supply. In thin liquidity, that's enough to print a new high. And once the market prints $73, psychology changes instantly. Sellers freeze, buyers chase, and the premium becomes self-reinforcing. Because now nobody wants to be the last one paying $73 when it's $75 next. Step 4, the West reacts too late. The banks try to sell more paper to regain control, but at this point, the market isn't listening. Shanghai already led. The physical price already reset, and any paper selling just widens the disconnect between physical price and paper price. This isn't fiction. This is how markets break when physical overwhelms paper. We saw it with nickel in 2022, we saw it with palladium in 2020, and we're seeing it now with silver. And you're thinking, but why tomorrow specifically? Because tomorrow has a special mix. Momentum plus thin liquidity plus unresolved spread plus nervous shorts. That's why. Monday's momentum confirmed that Friday's smash attempt failed. Thin liquidity means serious buyers have disproportionate impact. Unresolved spread means arbitrage is still broken. And nervous shorts means they're watching Shanghai with terror. That combination creates the perfect environment for a spike. Now let's be disciplined. Here are 3 scenarios for Tuesday. Scenario A, base case, $72 to $73. Prints intraday. Premium stays strong, physical demand stays urgent, and $73 flashes at least once. That's the slow burn breakout. It sets up continuation. Even if it doesn't hold all day, the fact it printed sends a message. The floor is rising, pressure is building, and shorts are running out of time. Scenario B, bull case, 73.50 to 74 plus, and the spread screams. This happens if Shanghai buyers interpret Western hesitation as weakness and push hard into the vacuum. That's when Western shorts start sweating in public. Because at that point, the premium isn't just persistent, it's explosive. And once the premium hits $6, $7, or $8, you can no longer pretend it's just a temporary anomaly. It's an availability crisis. Scenario C, cooling case, Shanghai holds $71 to $72, but doesn't spike. Even this isn't bearish if the premium refuses to close, because it means the floor is rising and the system remains tight. The key variable isn't, did it spike today? The key variable is, does the premium close or persist? If it persists, pressure continues, and eventually, pressure finds a catalyst. In part 4, the final chapter, I'm going to give you the warnings, because when a paper mechanism is at risk of being exposed, the system doesn't just take the loss, it changes the rules, and you need to be prepared for intervention. Stay with me. We're ending with the reality of the battle. We've reached the conclusion. We've shown you how $73 can print in Shanghai tomorrow. We've walked through the mechanics, the triggers, and the sequence. Now we need to address the uncomfortable part. When a paper mechanism is at risk of being exposed, the system doesn't just take the loss, it changes the rules, margin hikes, trading halts, position limits, emergency statements. And if Shanghai is printing 73 plus, while the West is still pretending it's lower, it creates a credibility crisis. That's when interventions become more likely. So expect volatility, expect whipsaws, expect propaganda, because the battle isn't just price, it's legitimacy. Let me be very clear about what the banks will do if Shanghai takes the lead. They will blame speculators. They will say the market is being manipulated. They will invoke emergency powers. They will raise margins to force liquidation. They may even pause trading, citing extreme volatility. We've seen this before. In 1980 with the Hunt brothers, in 2022 with nickel. The pattern is always the same. When shorts are trapped, they don't admit defeat. They change the rules. But here's the difference this time. The physical market is too strong. If they close the paper market, the real trading will move to the street. It will move to Shanghai. It will move to private peer-to-peer networks. Closing the casino won't stop the game. It just proves that the house is broke. And it accelerates the move away from COMEX pricing toward physical-based pricing. So while intervention is a threat, it's not a solution. It's a band-aid on an arterial bleed. The fundamental problem remains. Physical demand exceeds physical supply, and no amount of rule changes can print silver bars. Now let me give you the bottom line for tonight. $73 plus in Shanghai tomorrow is not a fantasy. It's a logical consequence of a broken arbitrage bridge in a tightening physical market. If the premium widens even a little, if the West can't close the gap, if one serious buyer hits the tape, $73 prints. And when it prints, the headline won't be silver went up. The headline will be, Shanghai is setting the real price, and the West is running out of excuses. Because once Shanghai leads, the West has two options. Follow or expose that they don't have the metal. If they follow, the shorts get crushed. If they don't follow, the disconnect between paper and physical becomes undeniable. Either way, the banks lose. That's why Tuesday matters. That's why this isn't just another trading day. This is the line where Western control of silver pricing can break permanently. So here's what you need to watch tomorrow. First, the Shanghai Open. Does the premium open firm or collapse? If firm, we're on track. Second, the Western response. Can the banks push paper price down, or does the market hold? If it holds, their control is ending. Third, the level printed. Does $73 flash even if only intraday? If yes, psychology changes. Fourth, the spread. Does it widen or narrow? If it widens, the crisis accelerates. Those four indicators will tell you everything you need to know about whether we are witnessing the moment Shanghai takes permanent control. And if that happens, the implications go far beyond silver. Because if the West loses control of silver, confidence in COMEX pricing for all metals starts to crack. Gold follows, copper follows, and eventually the entire dollar commodity pricing system is questioned. Silver is the smallest market. It's the most vulnerable. And that's why it's breaking first. But it's just the beginning. So don't be fooled by tonight's calm. The storm is building. The Asian session opens in hours, and when it opens, we'll know if the banks can hold the line or if Shanghai takes control. Monday was the warning. Tuesday is the test. And if $73 prints, Wednesday is when the panic starts. Because once the market sees that Shanghai can lead and the West can't follow, the race for the exits begins. The shorts won't be able to cover fast enough. The buyers won't be able to buy fast enough. And the price won't rise gradually. It will reset. So here's the bottom line for tonight. $73 in Shanghai tomorrow is not a prediction. It's a read of market conditions under stress. The bridge is broken. The premium persists. Physical demand is urgent. And the banks are out of tools. All it takes is one push, one buyer, one delay, one rumor, and the market jumps. And once it jumps, confidence shifts. And once confidence shifts, models break. And once models break, price becomes what it always should have been, a function of physical scarcity, not paper manipulation. That transition is happening now. Tuesday might be the day it becomes undeniable. Subscribe, because tomorrow we'll be tracking the premium, the spread, and the key prints. And if $73 hits, we'll know exactly what comes next. The battle for control of silver reaches its climax, and you'll be on the right side of history. Don't get shaken out, don't sell. And don't underestimate what's about to happen when Shanghai takes control and the West can't follow.